We all rely on farmers and ranchers, but farming is riskier than other businesses out there. Crop insurance helps farmers manage their risk. With crop insurance, farmers put skin in the game by paying premiums and shouldering deductibles. That keeps taxpayers from having to pick up the whole bill every time disaster strikes. Today, about 90% of U.S. farmland is insured, providing $100 billion in protection to more than 130 different kinds of crops. It's a testament to the program's success.
Thank you for joining us for our Agri-Pulse Washington Weekend Review. I'm Spencer Chase, joined as always by Agri-Pulse Executive Editor Phil Brasher, as well as this week by Seth Meyer, the Chief Economist at the Department of Agriculture. And Seth, obviously a very busy week with the Ag Outlook Forum, the 97th Annual Ag Outlook Forum, and the first ever virtual Ag Outlook Forum. And one of the things that the Chief Economist always does to kick off that event is kind of read through a laundry list of expectations and figures for the agricultural industry in the coming coming production season. A couple of the numbers that you read off to kick things off this year were some massive record trade expectations in regards to overall expectations of, let's see, check my notes quick, 157 billion, $31.5 billion of that specifically to China. But as we look at, kind of dive into those figures, those are fiscal year figures. And that's something where, as we look at if we drill down specifically on the China figures, there's also this phase one trade agreement at play. And, you were not in the government at the time when that negotiation took place. You were not in your current role. It would be irresponsible of me to, put the requirements of the phase one trade deal on your plate. But that did involve an expectation of, in the ballpark of about $40 billion for the 2021 calendar year, not fiscal calendar year. So I'll ask you, are phase one trade expectations at play, do you think, in the calendar year 2021, given what this $31.5 billion that you've anticipated for fiscal 2021, which ends at the end of September?
So I think that when we look at our balance sheets, and they're talking about those balance sheets in detail right now, as you and I are discussing this, the grains and oilseeds outlook folks are discussing it right now. And while I wouldn't propose what the add up for 2021 calendar year will be exactly, in order to get to those export volumes for things like corn and soybeans and pork, and to achieve those prices that I laid out yesterday, you have to have pretty solid exports. I think folks would say we had a good trade year in 2020. We had a good trade year. Did we hit those targets, which, people pluck that top line number out of there and say, this is the number? When you read down in some of the other details, there's lots of things about at the market and other details. It was a great trade year. We shouldn't discount that. And in order to get to those prices we're talking about next year, when the folks are doing their outlook, again, for both grains, oilseeds, and livestock, it's going to take a fair amount of continued strength in exports. And we expect
that. Seth, looking ahead, kind of setting aside the phase one deal and the commitments that China made there, for example, how durable is this really robust demand from China beyond 2021? As you've talked about, the rebuilding their swine herds, big demand for corn and beans, but can we expect this to continue beyond 2021?
So this is one of the fundamental questions, and that's why I think the speech I gave yesterday was maybe different than normal, which is, if there was ever a time I would want to equivocate, this is the year that I would equivocate, right? We've just come through something incredibly unusual in 2020. And even in 2020, pre-August and post-August are like two different worlds in the grain market, right? I mean, just think about producers' feelings and emotions before August and how those emotions look after August, right? And so this is absolutely something we've struggled with. And from our standpoint, we continue that strength through 21-22 crop year in terms of Chinese demand. Now, I can't give you a China number because it's kind of buried down in there, and you'll have to wait for May when we do the whole globe at the same time. But you can't get to those trade numbers that we're putting out right now without that strong trade growth. I think, as you saw yesterday, I always want to. It makes me a little nervous, right? Because there are many things we don't know about the Chinese market. We don't really know what their stock levels are. Their official numbers for production constantly change, and they'll change their production number and they'll change it for the prior 10 years, right? I think when we see soybean strength, that's clearly on the strength of the rebound in their swine herd. For corn, it certainly seems like it's underlying demand as well too. I can keep going. I mean, we can talk about this for hours, but maybe you want to follow up.
I want to ask you about farm income too. Your new forecast, it's down a bit because you're obviously not expecting anything close to the amount of government payments this year, but still well above historic, the 20-year average. And you're at the same time projecting a record amount of corn and soybean acreage this year. It was 182 million acres, huge amount. And that's assuming a good weather in planting, which we haven't had for the last couple of years. Could we see prices even better than what you're projecting, which is, I believe, 420 on corn for this crop?
11 plus.
Futures, obviously better than that. That's old crop.
Yeah, I think So you're right. I mean, I think we talk about that's the price given our assumptions, and you can talk about, hey, there's risks around that as well too. We see the Brazilians planting a large second crop, and last month we moved up area in Brazil and moved down yields a little bit because the yield potential being trimmed because that crop is getting in late. So of course, weather always has the last say in this, right? It always does. Weather will have the last say on the size of that Brazilian crop. Weather will have the last say on whether we really achieve that 182 million acres or whether we get more than 82 million acres. It'll be key. Prices obviously matter. Weather always has the final say. So, what we have in there though is normal weather for planting. You're right. Folks kind of don't think last year was all that abnormal because of 2019. But we had quite a bit of prevent plant in 20. You're absolutely right. So we'd gain back acreage just for more normal planting weather. If we don't get that, you're in a different game. And part of what I was talking about yesterday is in this pre-August and post-August is that post-August, our views on the size of the crop, both corn and beans, kept shrinking. And at the same time, and prices rising. And at the same time, the Chinese didn't let up. The Chinese continued to buy. So the Chinese were continuing to buy and actually strengthening their buying in the face of rising prices. So you're right. There's two parts of this. How much do we actually produce? How big is that Brazilian crop? How big is our crop? How do the Chinese respond? And that goes back to what's the durability of this Chinese demand? And as we talked about yesterday, we've seen this volume previously from China, but it wasn't so corn focused. It was DDGs and barley and sorghum and lots of other mixes of different crop. And corn was actually the minority of that. Now you move forward and it's maybe even a little bit stronger aggregate demand, but very corn focused. So I think that there's another dynamic there too. So far, we're benefiting from that trade. There are SPS issues which keep Brazilian corn from flowing to China at the moment. There's another risk to the market, right? If that were to change, the dynamic might be a little bit different. Right now, we benefit a little bit from that.
Mm-hmm. I want to ask you a little bit, can't let you get away without talking about climate policy. It's the obviously number one priority for the Biden administration, as well as dealing with the pandemic and racial justice. But when it comes to climate policy, your office is going to be right in the middle of that. And with crop insurance, you had the chair of the Federal Crop Insurance Corporation, be reviewing policies. And there's a lot of interest, I think, in this incoming administration in trying to use crop insurance to encourage cover crops, conservation tillage. What kinds of issues are you going to be looking at with regard to crop insurance in the ability to possibly provide some premium and reductions or incentives, certainly for conservation practices, climate-friendly practices, if you will?
So, these are, it's always good for me to point out that I'm not a policymaker, right? I'm the person in there that tries to say, hey, I get the good intention, but that's not a good idea, or no, that'll work because of this, right? So my office really sits there in the background and tries to help separate the ideas with good intentions but bad outcomes from good intentions with good outcomes. So, I can tell you, though, we've been asked a wide range of questions on this subject. We've got some folks very intensely involved in this. They're trying to figure out everything from, what funds do we have available? What authorities do we have? Do we base outcomes? Do we base it on practices in terms of if a farmer does this practice, this is what we would accept, or is it based upon truly outcomes on this farm? This is the outcome. And so I think the complexities here are quite large. I think the incoming folks know that they're quite large. And I've given a lot of thought to this. You can read the writings of some of the folks that are incoming and really get the sense that they've thought about some of these challenges and they're really trying to move through and address these challenges. I think farmers really like crop insurance. Obviously, that's a program that works well for them. Do no harm and then see what else comes out, I think is probably the average producer's thought about this process. But we're there to try and advise very, again, good ideas, good intentions, bad ideas with good intentions, and try to separate those two out.
I want to wrap up talking about just kind of the last 12 months that we've all collectively experienced together, through no fault of their own. Any of the folks that were offering projections at last year's Ag Outlook Forum, they were promptly thrown out the window a few weeks after the event, as the consumer behavior rapidly shifted and producer behavior had to react to a certain extent due to the coronavirus pandemic. Now, we see cases, we cross our fingers, but cases appear to be on the decline. We see vaccination rollout happening and with differing timelines on when we think we can build up some level of herd immunity there. I say all of that build up to ask you this, from a strictly agricultural economics perspective, is COVID-19 behind us, or is there a longer tail on some of these ramifications that you're going to be continuing to watch here in the next couple of months, maybe next couple of years?
Oh, no, absolutely. I mean, nothing more has been more humbling to an ag economist than the last year, right? Even some of the things I think I predicted that were right were for the wrong reasons. So even if I got the outcome right, it wasn't because of the reason that we might have thought it was. And so I think when we look today, we're not out. We see these things continue to happen. I mean, we've got a disruption now with container shipping, right? I mean, so there's a long tail on COVID. We haven't resolved all these issues. And so you see container shipping prices going through the roof. That concerns dairy folks. It does have some implications for return freight on agricultural items. And so I think we've got a long tail on this. On top of that, while I think the livestock slaughter has really rebounded faster than many folks expected, there's also a cost underlying that, right? And that cost is there and it's maintained. And then even then, we don't know what we don't know about the reemergence of any of this stuff. So I think that there's a lot, and then the demand side. Will folks return to driving? Will folks return to driving their cars? I think I said yesterday, I had the same tank of gas in my car for 2 or 3 months. Will folks, we're sitting here talking and enjoying it, and I'm sitting in an apartment and you're in your studio. Will folks go back to going to the office? So I think that, no, this has a long tail. I think that my speech yesterday was really I don't want to say anything with specificity because I don't think we know. Right. So it was more about the risks. I think the risks beyond these market fundamentals that we were talking about earlier, China trade, they're still there. What does demand evolve and look like? While GDP comes back strongly, what happens to disposable income? Disposable income actually went up last year. And along with that, we had really good meat consumption. Does that unwind next year? Because the meat sector needs that robust domestic demand along with those export markets to get them where they need to be. So, no, I think from an ag economic standpoint, we have to continue to watch this stuff all year as some of these things unwind.
So obviously a lot of things to watch from that ag econ perspective, from that policy perspective that we briefly touched on. A number of things going to be on your plate and on ours here these next couple of months as we watch the some of these predictions made at this week's Ag Outlook Forum unfold into reality, so to speak. So obviously a very busy week for you. And Seth, we appreciate you taking a little bit of time to join us.
No problem. Love it.
For Seth Meyer and Phil Brasher, I'm Spencer Chase. Have a good one.